Hello, I'm Daniele from Zeygos, and today I'll be sharing with you an analysis of the financial markets prepared by our research office. If you appreciate our content, I invite you to subscribe to the channel. Is it better to invest in a few stocks or diversify as much as possible? Only one fund out of thousands has managed to outperform the Nasdaq 100 over the last 5, 10, and 15 years, and this was achieved by investing in a very limited number of companies. Ron Barron, an 80-year-old Wall Street veteran who still manages the fund, attributes his success to a combination of faith in entrepreneurs like Elon Musk and the constant monitoring of the companies in his portfolio. However, this strategy of heavily betting on a few stocks doesn't always work, quite the opposite. It has an extremely low probability of success for most fund managers. We could say it's an exception. A study conducted by Antti Petajisto, a former professor at New York University and a quantitative manager, shows that most such efforts usually fail because there are too few winning stocks in the market to make this tactic work, except in rare cases. The debate on investment management is dominated by the observation that concentrated equity positions are more likely to underperform than outperform the market in the long term. This trend seems to intensify in the modern economy where success is increasingly concentrated in a few companies. And, of course, winners are only known in hindsight. Let me provide you with some numbers. Since the global financial crisis, the US market has risen sixfold, but this rise has occurred solely due to the stellar performance of a handful of stocks. This has repeated itself this year as well. In 2023, the Russell 3000 is up 15%, but if you take the average returns of all stocks without weighting them by market capitalization, the return is negative, minus 0.7%. More than half of the stocks in the basket, I repeat, more than half, are down since the beginning of the year. And if you think this is confined to the Russell 3000, you are mistaken. The performance gap between the equal-weighted S&P 500 and the S&P 500 was 12 percentage points in 2023, the largest underperformance since 1998. This poses a challenge for active fund managers because if they follow the index, replicating the weights of the stocks in their portfolio with the index's weights, they cannot justify their higher costs. However, if they deviate from the index, they risk missing out on the substantial gains from companies like Nvidia and Tesla. Now, in hindsight, we know that to perform well in 2023, all you needed was to be long on the Magnificent Seven. But how many funds bought all of the Magnificent Seven? According to Bloomberg statistics, only 18% of funds have all seven in their portfolio, while 21% of managers don't have any of them. At Zeygos, our view is that the advent of ETFs will exacerbate this phenomenon over time. The Big Seven are now on many ETFs with high weights precisely because they follow the market cap rule, which requires ETF managers to buy large quantities of these stocks because they have a significant market weight. As a result, the more the Magnificent Seven appear in a large number of ETFs, the more they will benefit from additional flows and uptrends, flows that will drive up prices further, increasing market cap. The combination of ETFs and the market cap rule generates a perverse mechanism that ends up creating corporate giants, leading companies in every reference sector. Notice how the stocks of the Magnificent Seven are each specialized in a sector and have become giants so massive that they could buy any other company in the world with their shares. I'm sorry, but fundamental analysis doesn't come into play here. There are much larger economic interests at play. And if the average manager doesn't perform, so be it. For more information, please visit the website www.zeygosonline.com. If you would like to receive our services on a free trial for 1 month, please email us at info@zeygos.com. Zeygos provides informational and analytical services only regarding financial markets and does not engage in any form of personalized investment advisory activities.